So I'd like to introduce the first of the two concluding sessions for this today's conference. It's on Scandinavian investment case in integrating ESG and climate risks in a portfolio. So we're going to try to make this session as interactive as possible. I'd like to introduce Annette Andersson, who's a portfolio manager and ESG specialist at SEB. Max Horster, sitting next to her, is partner at South Pole Group, which is a climate risk research firm. And Tal Ullman is director at Sustainalytics, which is an ESG research and ratings company. Let me hand over to Tal.
Can you hear me well? Yes, fantastic. Thanks. So first of all, thank you for the STOXX organization for asking me to join this panel. I'm also very pleased to see that STOXX have found this topic so important that they has 3 people to come and present, ensure that the messaging is really accurate and convincing. The next 10 minutes or so, I'll speak a little bit about the history of responsible investment, talk you through some of the motives and the different strategies that we see are being applied in practice, and then focus in particular on ESG integration, and that will be also the bridge to the next 2 sessions right after me. And we're definitely open for an interactive discussion here, and that's also why we had some of these statements, and we're going to have more statements later, because we want this to also be, let's say, we want it to be clearly something for you to consider in what extent that helps you in your business, to what extent that will add value to you or to your clients ultimately, and we can think along with you there. Let me see how that works. Yeah, perfect. So for those who don't know Sustainalytics, we're globally the largest independent firm who provides corporate governance and environmental and social research and information to investors. And investors in the broadest sense of the word, we see it buy side, we see sell side, we see banks using it in, for example, in lending, we see it in wealth management, but definitely also increasingly in the construction of indices and structured products, and we can speak about that later. Our headquarters is in Amsterdam. We're spread over the globe. We have more than 140 analysts who are covering specific sectors or specific themes. So a sector could be financials or automotives. A theme could be, for example, water scarcity or human rights or weapons, right? And we currently have over 250 staff members. If you look at how this industry has grown over the past few years, and that leads to the third slide. If you see how this industry has grown in the past few years, originally responsible investment was focused much more about what not to invest in. And there's a lot of loss in translation here and a lot of different definitions that are used, but not only different definitions. When people say, that they want to invest in a certain way, another party can understand in a completely different way. What's really important here to go back to what are actually the motives. And if you look at the history of responsible investment, it started very much so in North America with faith-based institutions who said, I don't want to invest in certain industries, so the so-called sin industries. These could be weapons, alcohol, tobacco, pornography, and so forth. That was very much a statement based on what the values are. So an ethical decision has nothing to do with the potential financial outcomes. Now, in Europe, the debate has much more been about managing reputation risk. And as such, I wasn't surprised. It was good to see that as a confirmation that when we just went through the statement that most of the audience here indicated that actually it's from external pressure that will lead to actually applying ESG factors. And I think that's an interesting observation because that also leads to the question, in what way can you then cater that specific need in order to ensure that you're meeting those external pressures, but also to ensure that you're helping your client to come up with solutions that help them for their particular either objectives of audience. A little bit similar with responsible investment, as also Professor Merton was speaking about the different sources of alpha, for those who were here earlier today. In order to try to capture different sources of alpha, you need to know what kind of source you're after, and then come up with a strategy that would cater that specific source of alpha. Same thing with responsible investment. In order to meet the objectives of your client, you first need to understand what their motives are. Based on their motives, you can construct a strategy that fits that particular motive. Now, what you see here on this slide is a simplification of reality, but it helps to kind of think along the different motives that we see in the market. So first of all, it's the motive of investors that want to create a better world, either by having a positive impact through their investments or by mitigating or decreasing the negative impact. On the right-hand side, you see those investors are trying to improve the risk-adjusted return or to enhance the risk-adjusted profile of their investment portfolios. Now, those investors are using ESG factors in a way to enhance their strategies. Those investors are particularly focused on maximizing risk-adjusted returns. In the middle group, you see the group that is more focused on reputation management, as we spoke about a little bit ago, but also aligning with their stakeholders. So that could be, for example, a charity that decides to not invest in certain industries because they don't think that's aligned with their mission, or a pension fund that decides to not invest in, for example, tobacco producers because they think that's not in line with their particular stakeholder group. For example, pension funds that would take care of the pensions for the healthcare industry. Now, when you look at all these motives will lead to different strategies and potentially different outcomes. In order to understand the strategy that works well for your particular client group, you need to therefore look at the motives and try to define what you're trying to achieve and how that could be best achieved from the perspective of ESG. Now, what you see here is 6 different strategies that are not mutually exclusive. They can be used in combination. Often they are. Sometimes they're used in isolation. Now, a lot of the loss in translation that we see is that when people say, oh, I want to invest sustainably, they think that, that you immediately know what to do then. But an investor can ask you, or a client can ask you, I want to invest sustainably, and that could be either of these strategies or a combination of these strategies. So the key point is to try to understand what they're trying to achieve and help along, think with them how, let's say, what the best way is to fit it into their existing strategies. Now, very briefly from the top to the bottom, negative screening is deciding on ESG factors to not invest in a certain business or company, business area. Norm-based screening is adhering to international norms and legislations that also have been signed by countries and applying that to your investments. Best-in-class or positive screening is selecting companies based on ESG characteristics and then investing in a particular universe that could be both passive or active. Could also lead to overweighing and underweighing based on ESG factors. The fourth one, ESG integration, that really relates to using ESG factors to assess the valuation or to do the valuation of an asset or a security. So the first 3, in a way you could argue, can be in most cases parallel processes. The fourth one really implies that you integrate that into your actual models. Now, on the first 3 ones, you can also you can very much see that from the perspective of doing it on a portfolio level. The fourth one, ESG integration, very much can be on both a portfolio level as well as an individual security level. The fifth one, active ownership and engagement, that relates to ensuring you're using your voting rights, for example, as a shareholder, and engaging with the companies, trying to change the behavior, trying to create beneficial change. And the final one, thematic or impact investing, really relates to looking to create a portfolio around a specific topic. Now, when people say ESG integration, our experience is that in many cases, people think about all these strategies when they mean ESG integration, not just here, particularly the fourth one. And that leads to the next slide. There's no golden standard for ESG integration, and people really have different things in mind when they ask you. So if you have a client that says, I want you to create a product with ESG integration, you really need to go back and say, okay, but what do you actually mean with the ESG integration? And depending on the answer, you should probably have a conversation about what it is that they're trying to achieve. Now, our experience is that broadly speaking, people, let's say a definition that is often used is, we integrate ESG factors in our process. That could be ESG integration. However, if you look at how the market is developing now, there's a narrower definition of ESG integration that's more and more applied, and that is really that you use ESG considerations in the financial analysis of an asset. That moves away from the ethical component of, I don't want to be investing in a certain asset or certain business, to actually, in what way can I enhance my return or enhance my portfolio strategy? Now, the most often mentioned approaches are actually, for ESG integration in a narrow sense, are actually on the security level or issuer level, but increasingly we also see investors take a more holistic approach. Now, we've been speaking today a lot about smart beta strategies, about passive strategies, about indices. If anything fits well within smart beta or index approach, is that you look on a portfolio level of ESG integration and try to understand where ESG exposure that you're creating through the indices or through the portfolio that you've created, where these exposures can actually hamper returns on the longer term. And then increasingly we're seeing parties experimenting with that. Now, what's really important to understand that the way you would integrate those factors would really depend on the strategy that you have either already designed or that you're about to design. There's a huge difference between active and passive, huge differences if it's a quant strategy or qualitative strategy. It also depends on the asset classes. So there's no one size fits all. If anything, it should be a conversation about how it adds value to existing processes. And we spoke about in some of the sessions earlier today about the various factors that you have. you should really see ESG integration increasingly, that's what your client base will be expecting from you, as one component within a larger set of components that you apply within your strategies. A question that we're often asked is, to what extent can the ESG analysis take, for example, Volkswagen? To what extent could you have predicted, what was going to happen? The answer is, like for most types of research that you have in the market, the answer is that's really difficult, right? You have anecdotal evidence, but it's really difficult to predict. If anything, ESG factors are increasingly seen as a risk factor. It's really hard on the opportunity side. On the risk side, you see that there are more and more indications that can help you to understand the risk in your portfolios and to manage them. And finally, and then I'm open for questions, but otherwise we'll hand off to the next one. Broad adoption has not been taking place yet. There's more talk than walk. That is not intentionally. It's not because people are lagging. It's because people are looking around and trying to see what works well. They want to be sure that what they're doing fits their clients. There's also a lot of experimenting going on, right? So on a small scale, we'll see institutions now trying to see how it could be fit into their existing models and then slowly expanding that within their client base. I know that in a little bit, Annette is going to speak also particularly what SEB is doing in that sense. And we're more than happy to have a discussion then. First of all, if you look at the quality of the information available on these issues, you see a difference between developed markets and emerging markets. Having said that, within emerging markets, it's just too simple of a term to use. You see that in some markets, you see fantastic information being available. Take, for example, Brazil, take South Africa. So there's a lot of information to base analysis on. That's in general kind of if you look at the globe. But even more than that, we see a huge amount of information having become available in the past few years. If you would have taken a snapshot of a few companies, take them today and take them 10 years ago, the amount of information available today on sustainability and ESG disclosures is uncomparable. So there's much more information today than a couple of years ago to actually base your analysis on, and also therefore it's much easier and more effective to actually integrate it in your strategies.
I will skip this. So good afternoon, my name is Maximilian Horster. I'm with a company called South Pole Group. And we are actually climate change specialists. We are the largest climate change specialist out there. We are 150 people in 17 offices around the world. So one office is here in London. I have 2 colleagues in the room here. And we do basically 2 things. We measure climate and sustainability impact for around 1,000 clients, companies, governments, agencies, and we help reduce climate impact. And a good 6 years ago, we started to actually measure climate impact of investments, and that's why we are here in this room today with you. And what I would like to point out on this slide where we measure our own impact as a company is that we actually, by today, have measured 2 trillion euros under management for their climate impact. What I find interesting about that is that this number 1 year ago was at 300 billion, and these 300 billion were actually the entire screening that we did for the previous 6 years. So what we see in this space is that investors are increasingly interested in climate change, and it's a dramatic change. So it's not a gradual development, it's actually a rapid increase. And I would like to talk for the next 10 minutes about why that is and how we see the market there. And that's maybe new to some of you, maybe interesting. It's relatively latest developments, so in line with the theme of this conference. So 6 years ago when we started, there were some mission-based investors who wanted to know, is our mission in line with the way we invest our money? So there were church investors who said, are we investing our money in the line with what we want to achieve as an institution? And so they asked us, are we helping or harming the climate? And so these were our first clients that we had. And it all started with so-called investment carbon footprint. So you measure the carbon footprint of an investment portfolio against a benchmark. This changed about 2-3 years ago when all of a sudden mainstream investors got interested in that. And where we are right now is that basically investors try to understand what is the climate impact of our investment. So this is kind of on this learning curve that we show here. By running carbon footprints, by doing deeper analysis on portfolios, integrating data into their investment process, to then, after they understand, to act upon that. And I prepared 5 statements on this topic that I would like to share with you, and then hopefully get some of the opinion of the panel and your opinion on that. My first statement is then that climate change is actually decoupling from the broader topic of ESG. So while, as I told you initially, we were working with investors that you would see as typically ESG investors, investors that are focusing on non-financial elements as well as financial elements in their investment decision. Now we actually have more clients who probably wouldn't know what ESG means or probably know what it dissolves into, but not to the depth of Tal's explanation, but are concerned about the topic of climate change. That has a wide variety of reasons. I want to give you one. So this is a statement from COP21, the climate conference that happened end of last year, where 196 countries, basically every country in the world, agreed to curb greenhouse gas emissions to stay within a 2-degree warming scenario, 1.5 to 2-degree warming scenario. Our economy out there is currently geared towards 6 degrees warming, right? So what that means is if politics get their act together, that means that the economies have to change, companies within the economy have to change, and societies have to change. We have to change the way we consume, the way we travel, and so on. So there is basically this idea that going forward, our economy will look quite differently if these countries do what they committed to. And that actually causes certain implications for investors right now, and it's starting very much in the institutional space, where investors say, well, if this is really happening, do my investments, as I have them right now, still make sense? What are major risks when companies that are currently geared towards 6 degrees warming have to operate within a 2-degree warming scenario? And where are investment opportunities? Because what came with COP21 was basically the commitment of 196 countries to invest €1 trillion a year into an area that currently sees no inflows whatsoever. So there is an opportunity to co-invest into that. And that is currently being looked at by investors. My second statement is that every investor will have to take a view on climate change. And I would say that will probably happen over the next year. So what we saw in the past was that investors said, yeah, climate change, topic for the church investors and maybe some others, but not for me. It seems now that investors have to take a stand, at least develop a view, and that is happening as we speak. And let me go back to COP21 quickly and why that is linked to that. So these 196 countries basically agreed that they will make, and that's in the Article 2.1c in the agreement, that they will make finance flows consistent with a pathway towards low greenhouse gas emissions. So that means 196 ministers of finance, 196 regulators. I'm sure there are a lot of countries that don't have regulators, but they have, by signing this, the mandate to now look at what the investment industry is doing in their jurisdiction, and they're currently in a fact-finding mode. So when you look out there, you see that there are a lot of governments that are currently, as we speak, running studies on what is the impact of climate change on our financial system. So you have the German Ministry of Finance conducting a study as we speak, results coming out in October. Sweden just published a study on that a month ago. The Swiss government is looking into this. The Dutch central bank published a report on this. You saw maybe the Australian Senate had an inquiry on this. And so basically what legislators ask themselves right now is that important for us? And do we need to regulate? And there comes in your vote at the beginning of the session, stakeholder pressure, right? Here, the stakeholder pressure is very much coming from politics and from the regulator. And that leads to my third statement. We will see over the next year new transparency initiatives popping up, voluntary ones and mandatory ones, on the topic of climate change and investments. And we see this already. So if you look at the country of France, you might have followed that the energy transition law requires French institutional investors to report on their climate impact, on the climate impact of their investments for the business year 2016 in 2017. So in 2017, every institutional investor in France will have to report what the climate impact of their investments are based on certain criteria. That's happening. So if you are managing money for a French institutional asset owner, you have already or will receive a call with the question, what's the climate impact? We have to report that onto our government. Same happens in California. The Californian commissioner for the insurance industry basically asked all the insurance companies in California to report their climate impact. These are 1,300 insurance companies. They must insure a lot of things there. And he combined that with a ask to consider divesting from thermal coal. So there's actually also an ask for action. And so we will see more of this, but at the same time, we see the financial industry turning this around and basically coming up with self-commitments on transparency. And you might be familiar with some of them, but there's the Global Investor Statement on Climate Change, and I think quite a few in this room have signed that. There's the Montreal Carbon Pledge, with now 120 large asset owners and asset managers that basically say we will report the climate impact, or already do report the climate impact of our investments for around $10 trillion under management. You have the Portfolio Decarbonization Coalition, led by the likes of Allianz, AP4, Amundi, that basically say not only that we will report on our climate impact, we set ourselves targets to reduce climate impact. And then you have these requirements. In Sweden, you have a de facto requirement for the Swedish pension plans, a strong ask by the ministry. And at the same time, you have products developing that you can, if you would like to look that up, on the low carbon investment registry, you find a lot of strategies that are dealing with this. If you have one registered, that's for free and gives you a lot of visibility. And that leads me to my fourth statement. We see that the fact that investors are now measuring their climate impact, and they measure it over time, leads to the need to manage it, to bring this down, to set yourself target and to manage that to reduce your climate impact. And that's actually a business opportunity that is seen by many, including STOXX. The idea to say, well, that requires clearly product. So you need product in order to be able to manage this after measuring. And so just to say a word about climate-friendly indexes, you might have seen them popping up. The most of the climate-friendly indexes that you see in the market are very much in this space. So they are either fossil-free indexes, so a fossil-free version, no oil, coal, and gas reserves of an existing index, or you see low-carbon indexes that are optimized over carbon footprint. So a low-carbon index has a lower carbon footprint than a reference index. That's basically the status quo. STOXX is now going a step further, added what's referred to a kind of a climate leader index, the idea that rather that you try to pick companies that are actually in a transition towards a 2-degree economy, so companies that have a climate strategy. So can you pick from a universe of companies those that actually have understood the challenge and transition into that? Because for an investor, that will de-risk and bring down climate impact over time. And then, there are a lot of other index ideas in the drawer. The point I'd like to make is we're really scratching the surface. We are just looking at the passive side here. We will see many more products popping up. And I would like to end with my fifth statement. While this is currently very much a topic that happens in the institutional investor space, retail investors are catching up on that. To give you one example is Climpex. That's a European Union funded rating system that will come out, I think, end of this year. It will basically rate every single retail fund out there in Europe, equity retail fund, on its climate impact. And the idea is basically to give that into the hand of the retail investor, so that the retail investor who on High Street walks into his bank, her bank, and says, I would like to invest in global equities, learns with this independent ranking what fund is better for the climate than the other. Well, with that, I would like to end interactively and ask you if I convinced you, actually. So the vote that we had put up there was, for the next 10 years, do you expect the topic of climate change to be, in fact, a key topic for all investors, to remain a key topic mainly for ESG investors as part of broader ESG, turn into one topic among others, so you see other topics popping up there, or to fade away?
Yes, I'll take it over. I work for SEB, which is a Nordic bank based in Stockholm, where is our head office. We've been around for about 160 years, 16,000 employees. We are present in about 20 different countries globally. And something really amazing happened actually with the bank in 2008. We actually developed the green bond market together with the World Bank. And at the same time that year, we actually signed the PRI, Principle for Responsible Investments. So we have been working in this space for quite some time. Sorry, that was the wrong way. Sustainability, this is our approach actually. And our conviction is, I've been working as a fund manager for 10 years, working with sustainable investments. And I'm completely convinced that companies who actually do consider sustainability factors into the operations are better managed. They got better control of risk mitigation, but also business opportunities. We have a responsibility as a bank at society at large, to our investors, to our clients, obviously. But our ambition is that we have to create long-term value or financial performance for our customers, but that's because that's what we promised to do. But we need to do it in a sustainable way, not just the financial side. I'm going the wrong way here. This is our journey. It started actually with influence. We're one of the largest asset managers in the Nordic countries, so we have very good access to company management. And we conduct stakeholder engagements, something between 200 and 250 stakeholder engagements every year. And then we talk to the CEO or the CFO. And we've been doing that for a number of years because that's the way the Swedish market works. We're kind of a small market. Exclusions we've been working with for quite some time. As Max and Tal said, just don't invest in certain topics or companies or this in stocks. And now that has actually, fossil fuels actually moving into the exclusion side, where we see a lot of divestment approach from our clients that don't want to be invested in the climate risk area. But the most important part, I think, is actually the inclusion side, which we've been working with. I started in 2008 working with the inclusion side because I got a mandate from the Church of Sweden to try and integrate sustainability into the equity portfolio. And that's quite interesting because you find other values or enhanced values. So what we actually been doing we revamped a global equity fund last year, where we included ESG factors into a quant portfolio. I'm going to finish with the numbers. I'm not going to go into those straight away. But that fund manager actually got that assignment, said that this is going to hurt performance. I don't really want to do it, but fair enough, I'll give it a try. And at best, it's just going to be neutral on the performance side. But after doing back testing, he actually realized that it enhanced performance. So he actually went from, I don't want to do this, to saying that this is the most important thing I've done in my life, which is quite interesting to see. Inclusion, yes. And we focus, the ESG topic or sustainability topic is really, really big. So we decided that we have to focus somewhere, so we started to focus on the environment. Why? Because it's a big topic, and also with the COP21 and also with the new Sustainable Development Goals as part of that. And we know the companies need to work for it, but also it's got to do with data and data quality, because in the ESG space, as you were saying, 10 years ago, the quality of data was just not there because companies didn't report, or if they did report, the quality was quite poor. But in the last few years, that has actually changed. And what we found was that on the environmental side, the quality of data was a lot better than the social side or on the governance side. We do believe that climate change is real and is happening, and companies need to address that. I mean, if we talk to mining companies, water scarcity is a major issue. And also in the retail space, these companies need to mitigate this risk and look at other ways to find ways to do business. We actually highlighted 3 themes, which is climate change, toxic pollution and waste, and natural resources. And why we did this? Well, basically with backtesting 3, 5, and 7 years, we consider these 3 factors together with an overall score actually enhance performance. So it's quite simple.
Why do they enhance performance?
Because, to be quite honest with you, we don't really know the why. We can just see the numbers. And probably it's because they have better control of the risk mitigation and business opportunities. And the why is still out there to try and find. This is the fund. This is the Swedish word, Hållbarhetsfond, Sustainability Fund. Just to give you an idea, I'm just not going to go through the numbers, but you can see that it's outperformed the index. This index is the ordinary index. It's not been changed at all. So we actually, it's the stock market. And as you can see, it's outperformed.
Pleasure.